Yes, you're most welcome. Back again to another video. So we looked at a few basic concepts you can put together to take a good trade at first in the previous video. So now I'm going to share with you a few more concepts that later on, when you advance in the other ones, you can add on to turn a good trade into a perfect trade or to turn it into more precise. These are one of the ways, these are one of the things you exercise when you want to move your win rate to a higher win rate. When you want to make your wins bigger, reduce your risk and yet increase your potential gain. It's hard. It's almost impossible because risk normally moves with gains. The bigger you want to gain, the bigger you have to risk. But there is a way to earn more, yet you risk less, yet you're earning more. So that's what I'm going to be looking at in this video. So I'm going to go back to our trade and show you one of the ways. I want to go back to our trade that we were looking at previously, which is this trade. Now, what I've done is I have scaled down into a lower time frame. This is exactly our same trade. It's still Ethereum. These are still the BOSS. I have moved from the daily time frame where I was, come to a lower time frame, which is 1 hour. I'm going to show you. This is going to help you appreciate the importance of top-down analysis, because top-down analysis can help you scale down your risk, but yet keep. So now I'm not going to replay anything. I'm going to keep all the charts there because you didn't know what played out. But I'm going to show you now what I would have done if I was live trading this chart and I was there that very day and I knew what top-down analysis is. How do I put it in my favor? Number one, the market is bullish. I know that. The market is bullish. It's getting break of structures going up. Now, let me zoom in this and show you guys that that's what I mean by these concepts are fractal. That even when you see the bullish thing in the one day time frame, it will remain bullish here. But the thing is, the lower you go in time frame, lower time frames capture more detail. For example, now this market, let me zoom in so that we see actually what was happening, ladies and gentlemen. When you look at this market, it was bullish, had a phase of consolidation here, and then bulled up. Okay? But after reaching this high, it started consolidating. Like any market, when it comes from down, goes up, forms a new higher high, first go down from a higher low, then continues up. If it's a good market, it will come down from a higher low in an efficient manner and then continue up. Okay? Now, see what happens, guys. When you are in a lower time frame, in the higher time frame, this can look like it's very small, like it's minor, it's very clear, it's bullish, guys, bullish. But when you start scaling down lower time frames, these can be a serious downtrend. Now, when you look at this exactly, is what I'm trying to show you. That when you look at this market, it was in a serious downtrend in the 4-hour time frame. But in the 1 day time frame, this was very minor. Like 1, 2 candles, 1, 2, 3, 1, 2, 3, 4, 5, 6. But in the lower time frame, now when I go to 1 hour time frame, it's even worse. It can look like a prolonged series of downtrend. How do I know it's a downtrend? It's breaking structure. But this structure it's breaking is internal. I have told you before about swing structure and internal structure. By swing structure, I mean this market is bullish in the bigger picture. The market, when you look at it, it is bullish. But internally, it has internal phases where it goes down, internal phases where it goes down. You see, these are internal structures. So even here, it had an internal bearish structure. Now, if you don't appreciate top-down analysis, you could rush to think, hey, the market is going down because you've read your break of structure. This was the previous low. It was broken here. Again, after this one, established this one, again, it broke this low here. So it kept having break of structure, then had another break of structure, but now it's in the downward trend. I think I'm going to remove this line and tie. Okay, this was the break of structure of the other thing. Let me just remove it for now since we already demonstrated that. Let me remove this line not to confuse us. Then it came, formed a new low here, then broke it again. There was another break of structure here. Now, ladies and gentlemen, we all know from the high time frame that this market is bullish, and we are waiting for this market to react in our demand zone. We have drawn it, it's an area of interest. We know it. What do you do as a wise person? This is what you do. In the lower time frame, you do what we call confirmation. You wait for a confirmation. You wait for the market, because remember, lower time frames have more detail. So by the time the market is bullish in the higher time frame, in the lower time frame, it has already become bullish. Just like in the lower time frame, it was a minimum reversal. Here in the higher time frame, it was the minimum reversal. But here in the lower time frame, it looks like it's a serious bearish trend going down, going down, going down, going down. That's exactly that's what you use. You use that very weakness of the lower time frame revealed to you. What do you wait for? High time frame told us the market is bullish. You wait for the lower time frame to confirm to you that now I am bullish. There you have two time frames that have confirmed. Let me show you how we do it. That's how we do it. So in this lower time frame, the market was coming down here. I think let me get this kappa thing. Market was coming down here, form lower low, come here, form a new lower high, then forms a lower low, then forms a minimum lower high, then comes from a new lower low. Or okay, you could also consider this one here. So what do you wait for? You wait for a break of structure that goes to the bullish direction, to upward direction. What do you wait for? What are you waiting for? You're waiting for inside that internal structure to form the market to turn and break structure. There are two options here. Either you're going to wait for the market to break this structure, then you enter. Or wait for it to enter inside this supply zone, go up a little bit, come down, and then go up and break. Let it form another structure, which is, I think, what happened for this case. That the market came down here, it was consolidating within the structure. All this time round, I'm not entering. There's another person who entered here. They also made money. Remember, because we already did that. They made money. But here we're saying, how do I make more money and risk less? That is the aim. That is the goal. You have to be a little bit more patient and more calculative. That means you must not be hungry. Because if you're hungry, you can't be this patient. You can't use this technique. So you're going to allow me to remove this thing. You've already seen it. Or let me just make it small. Let me make it small. Or I make it over go the other side here. Let me make it go this side. So that it is away. We already seen the win. So we're going to compare. Now, number two, the next thing you're going to look at is you're going to wait for this market to zigzag until it gives us an upward bearish momentum. So now it does it. It comes here. It goes up here. I don't know if you all can see. It goes up here. Yeah, it goes up here, goes down. All we want it to do is to break this new high it has created. There's a new high it has created here. Either we have to wait for it to break this high, or you have to wait for it to break this high, or you wait for it to break this high. Now, the highs you wait for it to break depend on how good you are at reading the market. Now, me, I can see that I don't need to wait for this high to be broken for me to know that the market has now turned to become bullish. Reason being, it has come down and it has created another high here. So then the market goes down, then it breaks that high. Do you see that? At this point, it broke that high. What do I do? The moment it breaks this high, to me, it tells me that it has formed another break of structure. Now, when I see that break of structure, what do? I wait for the market to, I draw my supply zone in the nearest demand zone here. So let me delete this upper demand zone so that you don't get confused in what I'm doing. I'm going to show you something. Let me delete it for now. Of course, you know it was there. So there's this demand zone here that I'm going to wait for the market to come back to and go back. What am I going to wait for? Number two things. I'm going to wait for this market to come back into this demand zone, and then I trade with it. That's one. Number two, I'm going to look for, is there any market inefficiencies that the market should first come back and be efficient in? If they are there, I'll be more confident. But at this point, they are not so much there. But what is giving me confidence is in the high time frame, there was a market inefficiency that has just been filled by this downward movement. Number two, I am in the supply zone of the upper time frame. Now here, I'm looking for confirmation. I don't complicate confirmations. I'm already biased. I know the market is bullish. All I'm waiting for the market to do for me is just create for me a break of structure that suggests you're bullish. In the lower time frame, in the high time frame, you can't see this. In the high time frame, all these could be one candle, so you can't see it. But here in the lower time frame, I can see that the market came up, then went down, then came up. So it has created a block of structure. It means it wants to go up. So I can immediately look for where is the nearest demand zone. And truth be told, there was a demand zone here. You can draw it any way you know how, any way you've learned how. Because when you're learning, you can draw it. So I can draw it in respect to this red candle or this one, or in the respect to the whole consolidation area. You see, and I draw it like this to respect the whole consolidation area. Then I wait for the market to come back there. Yeah, the whole consolidation area, because the whole consolidation area covers this upper week and this week. Get the point? Or you can say no. Mostly when you want to minimize risk, you draw it in respect to this candlestick here. This one here. Before the large momentum push came in. And now, truth be told, the market tagged us in narrowly. But remember, this all happens when you're still staying this side, so you don't know what is in the future. But you just take and say, me, this is where I'm going to enter from. I'm not going to enter from here because the market has come into my demand zone, because there was already a big demand zone here. All of you remember it, I'm sure. There was a big demand zone here. You know, say, for me, I'm not going to wait for this big demand zone. I'm not going to follow this big demand. I'm going to wait for this smaller one. When it tags me into this one, then boom, I go. So now let us measure and see. If you entered from there, what would be your return? Same target. I'm not changing my target. But all I'm saying is, let me enter from here. I ride this market go up here. And then I put my stop loss here. Now I want you to notice the difference. That you see, I've entered from here. Number one, it is below where I entered from here. But I am more sure of the trade. Number two, my risk is down 1%. This is the beauty, that I'm going to risk 1%, even get more, 21%. If this person risked 7% to make 20%. So that is the thing. How do I risk more to still get more? That is when you now make your good trade perfect through confirmation. One way to confirm is this. These are the few tips I can be sharing with you for you to understand. I'm going to share with you one more. These are higher concepts that you have to actually give your time to learn and understand and watch over and over. But these are things that you just can't get because you've watched the video. You have to practice, and someone has told you by the hand and lead you by the way. So in this trade, I want you to read the results. Number one, the target is 21%. The risk is 1%. The risk to reward ratio. Maybe some of you are not seeing what I'm saying. This is the way I'm reading from the numbers. The risk, let me get like a pencil here. The risk is here, guys. This thing here. The risk is 1%. The reward is 21%. The risk to reward ratio is 11. Guys, I am taking an 11 to 1 trade. Do you know what that means? That means for every dollar I risk, I make back 11. So if I'm using 10x leverage, that's times 10 for crypto traders, because we normally use leverage sometimes. If I'm using 10x leverage, means I'm going to risk $10 to make $100 in one damn trade. But this trade took 2 weeks to play out. But yeah, the concept remains the same. This is an example of a trade of someone who is like, let me say, a swing trader who takes trades for weeks, 2 weeks, 3 weeks. But this same concept can be applied in this fractal market. Because if I go to lower time frames, I can still spot for opportunities like this. But here I'm trying to keep myself calm to stick to what I came to teach in the video only, not to over confuse and to help you grasp. So that's number one way you can turn your good trade to a perfect trade. Number two way is by watching out for what we call liquidity. Let me just demonstrate that here. Whenever the market does this, this is common for the market to do. It will have a common line. It's reacting from up. People who trade support and resistance call that resistance, and this lower line support normally. So what happens is many people will be aiming to enter the market here. They're aiming to enter the market here and trade it going up. Maybe their stop loss will be here and they take it back up here because they believe this is going to be their line of support. Whenever the market reaches this line, I enter the trade, then I go up. I make my cut 10%, maybe I risk 1%, or the risk could even be bigger, 3%, whatever the case is. Then there are also other people who say, no, me, I'm actually shorting the market. I want to enter the market here and take it down to here. This is my target. And my risk maybe is like around here. So in literal sense, there are very many orders that are seated around this area, waiting for the market to come here and they enter. And there are very many stop loss orders here, people willing to let go of their money here. So these orders are very many. These stop loss orders are many. Even here, there are very many stop loss orders. Now, this is what we call liquidity. It's a concept called liquidity. Let me draw my box again here. And now I teach two more concepts, and then we call it a day. Number one, concept I'm introducing is called liquidity. Liquidity is money. The next one is momentum. When you understand these two concepts, they perfect your good trade. After having understood market structure, you have understood how to read the market structure, you understood how to apply your point of interests, maybe supply and demand for this case, and then you've understood how to read efficient markets and inefficient markets. The next thing that you have to learn is liquidity and momentum, because when you can read points in the market where there's a lot of liquidity, you'll be at the safe side. Because what happens is here, the market can come and sweep all this liquidity, and after sweeping it, then it goes up in that direction. It gets all these people's stop losses, and then it goes up. Or it can come and sweep these people's liquidity, and then get all these stop losses. The market gets money here, because the moment it triggers you, it goes, stops you out, and then continues in this direction. That's why it's very risky to trade in these zones and areas, but that's not the concept for today. Today, we are looking at one form of liquidity. We're going to look at only two forms of liquidity, but there are many. But I'm just explaining the concept of liquidity, basically for you to understand that it exists and actually drives the market. Now, this is not because that the big traders or the institutional traders hate you, so they want to come and hit your stop loss. No. But rather, why that happens is because, like I told you, the market is driven by orders. These many orders, these many stop loss orders here, there is the way they attract the market. And one of the things that drive the market, the fuel of the market, is liquidity. When there is no money, nothing can move in the market. So for the market to move, it needs money. And there are people who have put a lot of money here, so it comes for it. Why? Because the market makers can read orders. You get the point? You can see that every time you reach here, there are very many willing buyers. Then you come here, the market is sluggish. Then you also hear there are very many willing buyers. You get the point? So you can start to see those points. If you're a big trader, you can also see them. But also when you're reading the charts in the market, you can also see those points that, there are very many orders seated here, seated here. That's what liquidity means. So whenever there's liquidity, the next thing that happens is called a liquidity sweep. And liquidity sweeps, you always see them characterized by candlesticks that look like this. Can I feel this thing? Okay, feeling is this. You can remember like a green candle. Then out of the blue, it has a very strong wick that comes and sweeps all the liquidity. This is what they call a liquidity sweep. The market tried to come down, then it was pushed back up. Or it can also be vice versa. It can be it has gone up, then it's pushed back down. So in most cases, wherever I see liquidity sweeps, you will find candles like this, candlesticks like this. So when you see such candlesticks, these ones, they are sweeping liquidity. Liquidity sweeps always look like those candlesticks you see with very long wicks. You just know, there's some liquidity that was swept here. You get. So momentum also is the pressure with which liquidity is swept. So you find a very long wick, here there was all the liquidity that was here was swept. If it was liquidity because of imbalance, that the market was moving so fast, that it forgot to fill the imbalance. It can have a serious liquidity sweep, then it continues up. Comes back and picks up all these orders, and the orders push it back up to continue in its upward trend. So those things happen oftentimes. You have to learn how to read them in the market. They also make your trade perfect. What else can I share with you here? Maybe trend liquidity. Let me delete this. I was just illustrating something here. Maybe trend liquidity could also be a good concept to, though me, I don't use trend liquidity, but you can use it also when you've understood how you use it. You can use it so well. It comes in handy so much if you know how to use it. There are very many other liquidities. This is momentum liquidity, sideline liquidity, like that. There's many. So what is this? Yeah, for a trend line, it's a trend line like this. Like the market is trending, then besides going down. So, and this going down, it sort of creates an imaginary line that it's reacting. Now, because of this imaginary line, then there are people who trade breakouts. They are waiting for the market to break out. Immediately they break out, they enter the market and trade it going up. So they have put their entries. Let me write here. Maybe they have put their entry zones, their entry points here. Their stop loss is here. Their stop loss is here. And they want to trade the market going up. That's one group. That's one group. There's another group that is waiting to short the market. The moment it clicks and comes to this entry line, maybe they enter like here, they put their stop loss here, and then they continue going down. Oh, I didn't show you another method also the market makers normally use for this trend liquidity. The one that is like, this equal high, equal low liquidity. It keeps forming many equal highs and equal lows. Instead of forming higher highs and higher lows, here it's forming equal high, equal low. Sometimes what happens most of the times, which confuses very many traders, is the market does this. It comes, remember their orders, their stop losses here, and there's also stop losses here. It comes, sweeps all these stop losses, comes, also sweeps these ones, and then continues this direction. It gets a lot of money here, goes up, gets all these ones, and then continues because it needs liquidity. So in most cases, the advice is whenever the market is trending like this, wait for it to break out of the trend and then establish a direction. Because without breaking out of a trend and establishing a direction, you can be swept out in one of these moves. These moves can sweep you out. So whenever the market is trending, in most cases, traders wait, be patient. So same thing can happen to even these people. The market comes very well. It goes here. It triggers this one's entry. Then it goes up, triggers this one's entry. Then it looks like as if it's giving them profit. Then it goes up, hits its stop loss, then comes down, hits this one's stop loss also, and then continues. The market was still going to continue in this trend. It never told you that it was going to reach here, then start going up. No. That's why when you're reading market structure, I emphasize read the break of structures. If the market has not broken structure, don't conclude. You get the point? Don't conclude yet. Don't conclude just yet. Because sometimes it can do this very well without breaking this structure. Get it can be all playing within here. It has not broken structure, and then for you, trying to enter it and long it here. It has not yet showed you that I have changed direction. I'm tired of bearish trend. I'm now going up. Just because you're a trend line trader. So it's very key. There are also other liquidities, maybe momentum liquidity, blah, blah, blah. But those are different methods that when you learn to read them in the market also, they can improve your win rate. Okay. Yeah, I think for today, that will be it for today. I've showed you a few tricks to perfect your trade. Let's move on to the next part of building your system. Having understood the things you follow, I've showed you examples of how you do a process for analysis, how you refine even your execution, how you get a good trade and how you get a perfect trade, how you execute, how you manage risk control. So let us now go to the other part of what rules you can bring up. What do you do after you build up those rules? Yeah. See you in the next video.